Welcome back, folks. Dow Industrials right now are down 42. You get the NASDAQ off 34. S&Ps are down 14. And when we go over to the commodity market out here, folks, we get sugar off 2.5%. We go take a look at the, let's see, corn's up 0.9%. We have wheat up 2.5%. Beans are up 2.8%. And right now we get our man, Mr. Sal Gilbertie. Sal is the president, folks, of Teucrium Funds. And if you want to get your portfolio diversified, folks, right at the NYSE, you want to trade corn, soybeans, sugarcane, wheat, or you want to put them all in one fund, you can do that. Trading corn, symbol CORN, soybeans, SOYB, sugarcane, CANE, wheat, WEAT, and combine them is the TAGS. And you talk about something sweet, man. That sugar has gone to the moon. Sal, what's going on?
How you doing, Tom?
I'm doing great. Yourself?
I'm doing just fine.
You know, I'll tell you, I mean, I know that these are your commodities, but I'm telling you, I've been doing, the gold report since 2001, 2002, and it's pretty wild because when we were first getting into gold, I was thinking that, gold's going to go up and the rest of the market's going to go down. Then I realized that, what happened is that everything went up, okay? But it's been really interesting about the last 6 or 7 weeks. Even as the market's been pulling back, metals stop moving. But this is my perception now, is that we really got a commodity market that's moving because all these softs are also moving with volume now too, So that's my technical view. Now, I know you can give us a fundamental view because they just come out with an agriculture report last week, right?
They did, and that report, essentially, it didn't have many surprises. It did show, though, that wheat acres were a bit steady. Corn acres were down, and that was not unexpected, I think. But more importantly, I think, on a macro level, to your point, the CRB index looks like it's trying to put in a bottom here. Sugar looks like it's trying to put in a bottom, and you've got the real strengthening against the dollar today. I think that that's probably a pretty good sign. And some people in the soybean markets today thought that made a big difference. That the real strengthening, dollar weakening, that might take some Brazilian soybeans off the market. Soybeans, I think, were up almost 3% at one point. So you've got these markets moving, and then you've got the seasonal where we're in peak harvest time here in the northern hemisphere. Corn and soybeans and wheat are all coming in hard. Corn especially. You're knocking on the door of cost of production. If you look at these continuation charts, corn at $3.60 a bushel. Wheat basically dollar higher at $4.60 a bushel. Beans, call it $8.60, $8.80 a bushel. They're really having a hard time getting through those numbers. So from a cyclical basis, we're looking probably at some potential seasonal lows here, which is being confirmed by the CRB index and the other commodities having a little bounce.
And folks, as you come over to our website at TFNN, the last time Sal was on, we got a couple great charts and a white paper. It's right under breaking news, and it's the seasonal price pattern in corn. Yeah, and it's really wild. And what's crazy is that everyone keeps talking about the strong dollar, but yet the dollar, to me, topped out like 8 months ago. So it's going to be intriguing to see how it attacks. August 24th went to a low. It went fast, furious. And I understand the fundamental concept that the dollar is stronger than everything else, but all the currencies are weak. So it's like, you're eating something, it's a hard asset. It looks to me like we got some hard assets that want to go higher.
I'll tell you what, you hit on a key point. The demand figures in last Friday's report showed very high demand for wheat, very high demand for corn, very high demand for soybeans, record in some cases. So demand is not abating no matter what the economic turmoil. We keep saying this, and it's true. People will not stop eating. They will not stop feeding their animals. They will not stop using the fuel that is, ethanol-based and soybean oil-based. And so we really have a very steady and, in fact, growing demand for grains. It may be growing slowly, say 1% a year or so,
sure,
but it's growing. And even with economic uncertainty, when you see grains down here on their cyclical lows, when you've got a seasonal in place that seems to actually be kicking in, where your harvest seasonal, all that supply comes to market in 8, 10, 12 weeks, there's some potential opportunity here for investors.
You know, when we talk season, so I know that they go out, they get all the stuff off the ground, they put it in storage. That just totally makes sense that's where a low would come in. I mean, it's a supply and demand deal, right? You know,
it is. It is. And in fact, I think if people read that seasonal study, they'll see that in the last 26 years, if you look at the December corn futures contract for next year, which happens to be what our ETF holds as well.
Yes.
Because an investor's in it for the longer haul. You're not in it just for a week or two. You're in it to buy and buy the down cycle. And so if you're owning out the curve, if you look a year out during harvest season, 46% of the lows in the last 26 years have come in between September and December. And in fact, December has the most, with 6 of 26 lows. And I think, again, to your point, farmers come into the fields now, they're harvesting, and most of them are putting it in storage. They're putting what they can harvest into storage, waiting for that late spring rebound that often occurs. And what happens is their bins will get full. So at the very end of the harvest season, down towards November-ish, they run out of room and they have to sell. And I'm convinced that that's what results in that sometimes December seasonal low versus the October 1st low, which is really strong seasonal in corn.
Man, I would have loved being a kid running around a couple of those farms and see where those bins are getting filled, man. Right?
Yeah, it's good fun. It's good fun. I worked for Cargill and was out at, buying corn at grain elevators in Iowa for a bit. It's an interesting thing. It really is.
Well, because, when you're understanding the actual physical like that you're out in those fields and you're realizing, hey, these things are getting filled. I mean, we see it as a digital deal, and it's great that you have a study like this that we can look at. But I know when you have a hands-on type of deal, it's like, hey, where's it going to go? It can't go outside because it gets ruined, right?
I think that's why I'm so amazed that more people don't pay attention to the seasonals, especially in ags.
Right. I can definitely see that. There's plenty of people that we talked about the different ETFs that you have: corn, soybeans, cane, and wheat. Now, the tags fund, you have all 4 of those in one fund, right?
We do. It's the old Deutsche Bank fund, the DBA, which now is a broad basket. It's a very good broad basket agricultural exposure fund. Not my fund. I don't get anything for plugging it. But I found that it was people needed to get direct exposure to the big 4, what we call the big 4: corn, soybeans, wheat, and sugar.
Yes.
And given that corn and soybeans compete for land, wheat is wheat. It's basically grown the same time and most of the same places that corn and soybeans are. And sugar, sugar is a big agricultural commodity that does have some pretty good seasonality to it. Sugar's an interesting market right now. We are 5 years into a bear market because there's been more supply, more sugar grown in the world in the past 5 years than it was demanded, and this year it's flipping. There's going to be more demand than supply. And
it's moving higher, there's no doubt. Well, listen, we really appreciate the update. We look forward to having you on again, and welcome to the bull market, man.
Pleasure as always, Tom.
Okay, man, have a great one. Have a safe one. You stay right there, folks. We're coming right back.